Have you ever noticed that sometimes the biggest moves in gold and silver don't begin with the metals themselves? They begin thousands of miles away, hidden inside trade numbers, employment data, and economic reports that most investors never read. Today is one of those moments. In just a few hours, the global market could receive signals that shape the direction of the US dollar, Treasury yields, Federal Reserve expectations, and ultimately, the next move in precious metals. So before you decide whether to buy, sell, or simply wait, let's connect the dots that many headlines are reporting separately but very few analysts are putting together. I'm Alex James, and in this analysis, we are looking beyond the headlines to understand what these developments really mean for the global economy and the bullion market. The data we discuss today comes from recently released economic reports and verified market updates. The facts are official, while the analysis represents my independent interpretation of what these numbers could mean going forward. Let's begin with China because the latest trade figures have surprised almost everyone. China's exports in July jumped by approximately 23% year over year, significantly outperforming market expectations. That is not just another economic statistic. It is a signal that demand for Chinese goods has remained much stronger than analysts expected, despite tariffs, geopolitical tensions, and concerns about slowing global growth. For the world's second largest economy to deliver export growth at this pace tells us that international trade remains far more resilient than many investors had priced into the market. However, the report also revealed another important detail. While exports accelerated sharply, imports grew at a much slower pace. This means China's trade surplus widened once again. On the surface, that sounds positive because a larger trade surplus usually reflects strong manufacturing activity. But when imports fail to keep pace, it can also indicate that domestic demand inside China remains relatively soft. In other words, overseas customers are still buying Chinese products, yet Chinese consumers and businesses are not increasing purchases from abroad at the same speed. For commodity investors, this creates an interesting balance. China remains one of the largest industrial consumers of silver in the world. Silver is not only a precious metal, but also a critical industrial material used in electronics, solar panels, electric vehicles, medical equipment, and advanced manufacturing. Strong export activity suggests factories continue producing at high capacity, which could support industrial silver demand over the coming months. At the same time, softer import growth reminds us that China's economic recovery is still uneven, meaning industrial demand could remain vulnerable if domestic activity fails to improve further. Now shift your attention from Beijing to Washington. While traders were digesting China's trade numbers, almost every major financial institution turned its focus toward one event that has the potential to move every major asset class within minutes: the United States July non-farm payrolls report. This employment report has become the single most important data release for financial markets because it directly influences expectations about the Federal Reserve's next policy decision. Recent labor market indicators have presented a mixed picture. Weekly initial jobless claims were reported near 199,000, a level that remains historically low and suggests companies are still holding on to workers despite higher interest rates. A labor market that remains this resilient makes it more difficult for inflation to cool quickly, and that is exactly why investors know today's employment data could become the deciding factor for expectations on interest rates, treasury yields, the US dollar, and ultimately the direction of gold and silver. The market is now standing at a crossroads, waiting for one report that could change the entire narrative. As these economic signals continue to unfold, investors now face an environment where confidence can change within hours rather than weeks. Markets are no longer reacting to a single headline. Instead, they are constantly reassessing how each new piece of verified data changes the broader macroeconomic picture. That is why professional investors spend less time predicting one event and more time understanding how multiple events interact with each other. One of the most important relationships to watch is the connection between the US dollar, treasury yields, and precious metals. Gold and silver do not move in isolation. When investors expect stronger economic growth and higher interest rates, money often flows into US government bonds and the dollar. As demand for these assets rises, yields and the dollar can strengthen, creating short-term pressure on gold and silver prices. But this relationship is not always permanent. Once markets believe interest rates have peaked or economic momentum is beginning to slow, capital often rotates back toward precious metals as investors seek portfolio protection and diversification. Silver deserves special attention because its market is influenced by two powerful forces at the same time. Unlike gold, which is primarily viewed as a monetary and safe haven asset, silver also plays a major role in global industry. It is widely used in solar panels, semiconductors, advanced electronics, electric vehicles, medical technology, telecommunications equipment, and other high-tech manufacturing processes. This means silver responds not only to monetary policy, but also to changes in industrial production and global trade. That brings us back to China's latest trade figures. Strong export growth suggests that factories remain busy, and international demand for manufactured goods has held up better than many expected. If production continues expanding, industrial consumption of silver could remain supported even during periods of market uncertainty. However, the slower pace of import growth also reminds investors that China's domestic economy has not fully recovered. Manufacturing strength alone cannot guarantee sustained commodity demand if consumer spending and private investment remain uneven. This creates a balanced outlook rather than a one-sided bullish or bearish story. On one side, industrial demand provides an important foundation for silver prices. On the other, global investors are still closely watching central bank policy, inflation trends, and economic growth before making larger commitments to precious metals. That is why periods of increased volatility often produce sharp price swings in both directions before a clearer trend eventually develops. Another factor worth monitoring is market positioning. Ahead of major economic releases such as the non-farm payrolls report, many institutional investors reduce exposure and wait for confirmation instead of making aggressive bets. This temporary reduction in liquidity can amplify market reactions once the data is released. Even a modest surprise in payroll growth or wage inflation can trigger significant movements across currencies, bonds, equities, and commodities within a very short period. For long-term investors, however, short-term volatility should always be viewed within the context of the broader macro cycle. Inflation remains above the levels that central banks would ideally like to see, global debt continues to expand, geopolitical uncertainty has not disappeared, and governments around the world are still balancing economic growth with financial stability. These structural themes have not changed overnight. What changes from week to week is the market's expectation of how quickly policymakers can respond to them. This is precisely why today's combination of China's stronger-than-expected export performance, resilient U.S. labor indicators, and heightened anticipation surrounding the official jobs report represents more than just another news cycle. Together, these developments are shaping expectations for the next move in monetary policy, and those expectations will ultimately influence where investors choose to allocate capital during the months ahead. What makes the current market environment even more fascinating is that investors are no longer asking whether the global economy is strong or weak. Instead, they are trying to determine which economy is showing greater resilience and how long that resilience can last. That distinction is important because financial markets are forward-looking. Prices today are based not only on what is happening now, but on what investors believe will happen over the next 6 to 12 months. China's latest export numbers have certainly changed part of that conversation. A 23% year-over-year increase in exports is not something markets can ignore. It suggests that global demand for Chinese products has remained stronger than expected, despite tariffs, supply chain adjustments, and ongoing geopolitical tensions. Manufacturers that rely on international orders appear to have continued operating at a healthy pace, providing support for industrial production and export-driven growth. Yet investors should also recognize that one strong month does not automatically signal the beginning of a long-term economic boom. Economic trends are built over time through consistent improvements in production, domestic consumption, business investment, and consumer confidence. The slower pace of import growth reminds us that while China's export sector is performing well, its internal demand still has room for improvement. This balanced interpretation is exactly why experienced analysts avoid making dramatic conclusions based on a single economic release. The same disciplined approach should be applied to the United States. Recent labor market data, including historically low weekly jobless claims, indicates that businesses are still retaining workers despite elevated borrowing costs. That level of resilience has surprised many economists who expected higher interest rates to cool the labor market much more quickly. A healthy employment market generally supports household income and consumer spending, which together account for a significant portion of U.S. economic activity. However, strength also creates a policy challenge. If employment remains robust while wage growth stays elevated, inflation could take longer to return to the Federal Reserve's long-term objective. In that scenario, policymakers may have less flexibility to ease monetary policy. Markets understand this relationship very well, which is why every employment report now carries enormous significance. Investors are not simply counting jobs, they are trying to estimate the future path of interest rates, bond yields, and overall financial conditions. This explains why market volatility has increased around major economic releases. Institutional investors, hedge funds, banks, and asset managers are constantly adjusting their portfolios based on new information. Even when the headline numbers appear positive, the market's reaction depends on whether the data is stronger or weaker than expectations. Expectations, rather than absolute numbers, often determine short-term price movements. For gold and silver investors, this means discipline becomes more valuable than emotion. Chasing every headline or reacting to every price swing can easily lead to poor decisions. Instead, successful investors focus on the broader macro framework. They monitor inflation trends, employment data, manufacturing activity, trade flows, central bank policy, currency movements, and bond markets together rather than in isolation. That integrated approach provides a much clearer understanding of where precious metals may be heading over the medium term. As we move further into the second half of the year, markets are entering a period where every major economic release has the potential to reshape expectations. China's trade performance has offered one important piece of the puzzle, while the U.S. labor market is providing another. The next step is understanding how these developments influence investor confidence, Federal Reserve policy expectations, and ultimately the outlook for gold, silver, the U.S. dollar, and the broader global economy. When we step back and look at the complete picture, one thing becomes very clear. The global economy is not moving in a single direction. Instead, it is sending mixed but extremely important signals. China has demonstrated that its export sector remains remarkably resilient, while the United States continues to show surprising strength in its labor market despite years of elevated interest rates. Neither of these developments should be ignored because together they are shaping the outlook for every major financial market. For investors, the challenge is separating short-term market noise from long-term economic reality. Every trading day brings new headlines, unexpected price swings, and bold predictions. However, successful investing has never been about reacting to every headline. It has always been about understanding the bigger macroeconomic trend before the majority of the market recognizes it. Looking ahead, several indicators deserve close attention. The first is the official U.S. employment data, and any revisions that follow, because labor market trends will continue influencing expectations for Federal Reserve policy. The second is inflation, particularly whether price pressures continue easing or prove more persistent than expected. The third is the direction of Treasury yields. If yields remain elevated, they may continue supporting the U.S. dollar while creating headwinds for precious metals. If yields begin to decline because economic momentum softens, gold and silver could regain strength as investors seek both safety and portfolio diversification. China will remain another key driver throughout the coming months. Strong exports have demonstrated that global manufacturing demand has not disappeared, but investors also need evidence that domestic consumption and imports continue improving. A balanced recovery would strengthen confidence in industrial commodities, including silver, while supporting broader global growth expectations. For the precious metals market, this creates a very interesting setup. Gold continues to perform its traditional role as a defensive monetary asset during periods of uncertainty, while silver sits at the intersection of investment demand and industrial growth. If manufacturing activity remains healthy and monetary conditions eventually become more supportive, silver could benefit from both sides of that equation. At the same time, investors should remember that markets rarely move in a straight line. Periods of volatility, profit-taking, and temporary corrections are a normal part of every long-term trend. My independent assessment is that the next several weeks will likely be driven less by political headlines and more by verified economic data. Employment reports, inflation releases, manufacturing surveys, retail spending, central bank communication, and bond market movements will provide the clearest signals about where the global economy is heading. Instead of focusing on one isolated number, investors should evaluate how all these indicators fit together. That broader perspective often reveals opportunities that daily market noise tends to hide. Whether you are investing in gold, silver, the US dollar, or the broader financial markets, patience and discipline remain your greatest advantages. Emotional decisions are usually made during periods of uncertainty, while informed decisions are built on facts, verified data, and a clear understanding of macroeconomic trends. The market will always create opportunities, but only for those who are prepared to interpret the information objectively rather than emotionally. If you found this analysis valuable and want more in-depth coverage of the global economy, Federal Reserve policy, precious metals, and the macro forces driving financial markets, make sure to subscribe to Macro Bullion, turn on notifications, and share your opinion in the comments below. I would also like to know your view. Do you believe China's export strength is the beginning of a broader global recovery, or will the U.S. labor market remain the dominant force shaping gold and silver prices in the months ahead? And finally, remember that this video is shared for educational and informational purposes only. Every investor has different financial goals and risk tolerance. Always verify the latest official data, evaluate multiple sources, and do your own research, DYOR, before making any investment decision.